Okay, welcome back to Accounting 101, where we're going to start our discussion and study of inventories. And the title of the chapter is called Merchandising Operations. Up until this point, the example we've been using in our book, Smart Touch Learning, has been only providing services to customers, teaching people how to use the computer or whatever they do. Service revenue. Okay. Now we are going to start selling goods. They're going to start selling laptops and desktops and printers and what else? Who knows? Okay, so a merchandising operation is a business concern that sells a product as opposed to a service. As an accountant, I sold my services to my clients. Same thing with a doctor, a lawyer, engineer, architect, whatever. As opposed to a clothing store that sells sweaters and shoes and underwear. And a car dealership, well, car dealership can do both. They can sell the car and they can sell service. They can also sell parts. Okay, so again, we're selling sweaters or computers like Smart Touch Learning is about to do. Okay, so we have this new account called inventory. Technically, they'll call it merchandise inventory for short. It's an asset account. Okay, it's a current asset, and hopefully, it's a very current asset. The quicker you can sell something, the more you turn it over, the better it is. Come on, this thing. Why? I can get the index page to scroll forward, but I can't get this one. There it goes now. All right, so I give you a little example of what's going on here. The operating cycle of a merchandiser, they buy the inventory, usually on credit, then they sell it, again, usually on credit, and then they collect the cash, and then the cycle starts all over again. Hopefully you can collect enough on your sales to pay your suppliers. And later on in the chapter, we'll talk about different things on purchases, discount, sales discounts, and the like. The party selling it is usually called a vendor, or your company purchases inventory from another business that is called a vendor or a supplier. It could be a wholesaler, a distributor, okay, whatever. Financial statements, the same, but what we're going to see in this chapter, two things in chapter 5, we're going to be introduced to inventory systems and general stuff about inventories, buying and selling, and also the multi-step income statement. Up until this point, the income statements we did were single-step income statements because you only had service revenue. Now, the statements are the same, just like we had the classified balance sheet versus a simple one-step balance sheet. Our income statement is going to get a little bit more detailed, a little bit more complicated, but it's still just revenues and expenses, but we're going to categorize them a little bit. Okay, we still do balance sheet, we still do statement of retained earnings, we still do statement of cash flows. Okay. Now, we've had service revenue is the only thing we've seen so far. Now we're going to call from selling our goods, we're going to call it sales. I mean, I've said this how many times that accountants are reasonable, rational people. We tend to give things name that is somewhat descriptive and indicative of what the thing does. So if we're selling goods, let's call the revenues from selling product sales, net sales, gross sales. Gross sales is total. Net sales is, if we'll get into that a little bit later on, if there's returns, allowances, or discounts involved. Okay. Now, inventory is kind of unique because it's an asset, and we saw this during. It becomes an expense, cost of goods sold. Okay. Now, net sales less cost of goods sold is an item we call gross profit. Okay. Gross profit. Sales less the cost of goods, cost of the merchandise sold, net profit. Then out of net profit, we have to subtract our operating expenses, and we're going to break those operating expenses down into two categories. Selling expenses and general or administrative expenses, sometimes general and administrative. Okay. The cost of goods sold Uh, Again, and we're going to get into this in a little bit. There's two inventory systems. Next chapter, chapter 6, I think we might have an exam in between there. Chapter 6 talks about inventory valuation. In chapter 5, we're just introducing you to inventories and talking about the systems and getting used to recording entries for buying and selling of the goods in our inventory. Okay. The cost of goods sold is computed as the beginning inventory plus the purchases gives you a thing called the total available for sale. Subtract out the inventory, and that is what was sold, or the cost of the goods that was sold. Okay. You can calculate it that way if you're using a periodic inventory system. If you are using a perpetual inventory system, you will have an account called cost of goods sold that will track that for you. If you use a periodic inventory system, you don't, the cost of goods sold just stays there from last year and carries forward till the end of this year, and then you do computation and replace it. So if you have you keep track of what you accumulated in the purchases account, and you have to calculate the cost of goods sold as opposed to having it in a separate account by itself. Again, that's dependent on your inventory system. Did I close one or two pages here? Okay, it looks like it's all going one page. Yes, on page 5-4, I guess. They introduce us to what I just said, the periodic inventory system and the perpetual inventory system. And once again, we can't shake this thing being so logical and rational accounts. The perpetual inventory system, we do a perpetual tracking of every change in inventory, every increase, every decrease in inventory account we're going to account for. We're going to have to do an entry, a journal entry. The periodic system, you just keep last year's ending inventory, carry it forward all year, don't mess with it, and all the additions to inventory go into an account called purchases, and then we have to compute the cost of goods sold. A periodic inventory is you only periodically do a calculation to find out the cost of goods sold, or do a physical count to see how much inventory you have on hand, which you have to do to get that end of period inventory system. Let me put this on a little note card and put it up for you. Let's not use that. Don't have a little pad, so I'll use the big pad. Cost of goods sold. Equals the inventory, beginning inventory, plus the purchases, which equals the total available for sale, total goods available for sale, less the ending inventory, the inventory still on hand, equal the cost of goods sold. Okay, that's how you compute the cost of goods sold. As you'll see shortly, if you're using a perpetual inventory system, when we sell something, we have to make two entries. Okay. A periodic inventory system requires business to obtain a physical count of inventory to determine the quantity on hand. The perpetual system keeps a running total. So at any given point in time, you can look at your records and it will tell you what you have on hand, unless you have some theft or shoplifting or spoilage, shrinkage. Okay. Nowadays, with the barcoding so prevalent, and that's been around since like the 1940s or 50s, believe it or not. Almost everything anymore is a perpetual inventory system. Okay. Um, the reason we have the two systems is because of the differing types of products that different entities have for sale. Um, if you have a large, high-priced item, if you move high high-priced units, and maybe not real frequently, like automobiles, bulldozers, airplanes, Rolex. Well, yeah, I'll use the old classical example I always use with the watches. You have a jewelry store. The Rolexes are locked in the display case, and they're under tight control because they're, upwards of 10, 15, 20, 25,000 or more a watch. They would be, since they're so valuable, you want tighter controls on them, you would use the perpetual inventory system. The Rolex watches, on the other hand, are on a stand on the counter, that anybody can grab them. Somebody comes in and grabs them, they take 24 watches. What's it going to be? 24, $600 maybe. You take one Rolex, you're out tens of thousands of dollars. So if you're selling things that have a high volume but very low cost per unit, nuts and bolts, nails, you wouldn't want to have to keep track of all those one by one, counting them all the time. So you'd use a periodic system, do it once a year, twice a year, and do the computation of the cost of goods sold. If you're selling Mercedes-Benzes, you can easily track. Each one has a unique VIN number, vehicle identification number, and they're relatively low number of units, and you easily traceable, easily identifiable, one from the other. Okay. Perpetual inventory system keeps it running. It says computerized record. Well, maybe, yeah, today, but you don't have to be computerized. You can do it manually. Keeps a running record of merchandise inventory. That is the number of inventory units and the dollar value associated with that on a perpetual constant basis in real time. Every time you add to it, you debit the asset merchandise inventory. Every time you sell or return stuff, you will credit the asset merchandise inventory. Okay. So you have a record that will keep track of the units, what you paid for those units, their cost, and the units sold, and the cost of those units. Okay. And at any point in time, you have that record that tells you exactly what you have. You don't have to go look it up. You can just bring it up on the computer or whatever device you have. If it's a written record, you'll have a card or something. Okay. Today, a lot of these systems are integrated, automatic reorder when you get to a certain point. Okay. The cash register, the optical, everything is optically scanned anymore, just about. It's amazing. I think about when you go to the grocery store now at the self-checkouts, it even, you put the code of the vegetables and it, weighs it for you, and it can tell you, what, not only what, that it's an onion, it can tell you whether it's a Vidalia onion or a Bermuda onion or what have you. Purple onion. Okay. So, I'm just going through down to the bottom of the page. Got to turn the page. Bear with me. I have a difficult doing this with the electronic textbook. Okay. How are purchases of a merchandise inventory recorded in a perpetual inventory system? Okay. So they're showing you here with, again, using Smart Touch Learning. Our vendor we're Smart Touch Learning. We're buying stuff from a company called Southwest Electronics Direct. Okay, they're the vendor. We're dealing with tablet computers here. Okay, so Smart Touch Learning sends, places an order, and the vendor will ship the tablet, so what it was ordered, to Smart Touch Learning along with an invoice. They show you an invoice, Exhibit 5-3. A lot of information there. You see the little red blocks there, and then there's an explanation in the right-hand margin. There's the name of the company that is selling, the name of the vendor that is selling to Smart Touch Learning. It's being shipped to Smart Touch Learning. Now we know that they're in Pompton Plains, Illinois. Smart Touch Learning. 3, this is very important, the date of the invoice and the number of the invoice. So you have to, if you need to reference it. But the date is going to, you'll see the importance of the date later on. 6, so paid. 4, credit terms. Okay, 1, 2, 3, 4. Things aren't in order here. 4, 3 and 4 are closely related. 3 is the date of the invoice. 4 is the credit terms, and we'll get to that in a little while. The credit terms, there are 3/15, net 30 days. That means if Smart Touch Learning pays this invoice within 15 days of the invoice date, they can take a 3% discount. Otherwise, the net amount of the invoice is due within 30 days of the invoice date. Those are the credit terms. Then they have a description there. Touchscreen tablet computers. They bought 100 of them for $350 a piece, total $35,000. So we figure out what 3% is, and down there in the lower left-hand corner by the red number 7 box, they do a summary. Not everybody does this on their invoices. You have to compute it. So you can see the invoice date up there in the upper right-hand date is June 1st, 2025. So if you have a 3% discount within 15 days of that, it would take you to June 16th, and you'd only have to pay $33,950 instead of the full $35,000. So that's a pretty good break, 3% discount. If you guys can afford to do it, it is advantageous to do it. If not, you have to pay the whole amount by July 1st of $35,000. Okay. So a lot of information there. Purpose of the merchandise inventory, purchase of merchandise inventory. Okay, so the first thing was we're going to we don't have credit terms for this example. I said merchandise inventory is a current asset, so it's increasing when we're buying it from Southwest Electronics Direct. So we're going to debit an asset account called merchandise inventory for $35,000 and credit cash. Okay. Now, they could also choose to not pay cash if they got credit terms from Southwest Electronic. The only thing that changes would be the account being credited. Instead of cash being credited, we are going to credit a liability account, accounts payable, and pay them some point in the future. Okay. Bear with me while I try to turn the page. 2, 3, 4, 5, 6, 7, 8. Oh, come on. It's not turning. Oh, come on, page. Oh. It turns one page and then it won't turn the next. Okay, come on. Hey, it wasn't bad. 30 seconds to turn a page. Now we're going to have a whole bunch of new accounts we're going to be dealing with and being introduced to in Chapter 5. There's going to be an account called Purchase Returns and Allowance, or there's going to be Purchase Returns and Allowances. Then again, depending whether you're using the periodic system or the perpetual system, the accounting entries are going to be a little bit different. Okay. The chapter deals pretty much with the perpetual inventory system. The appendix to the chapter deals with the periodic, mainly because just about everything anymore is the perpetual because of the barcoding being used so extensively. Sometimes you have a product you receive that is not up to spec, or maybe it's scratched or the wrong color. It's not exactly what you order. So you'll call the vendor and alert them to this fact. And it's expensive sometimes to return merchandise. So they will sometimes give you a incentive to keep it by reducing the price you have to pay. That's an allowance. So it's going to reduce your investment. It's going to reduce your cost of that inventory. Okay. So refer back to the invoice. Suppose 20 of the tablets purchased on that invoice were damaged in shipment. On June 6th, Smart Touch returns the goods. Okay. So we're going to reduce the inventory for the damaged goods, and we're going to reduce the accounts payable. Okay. And they show you that on, I guess it's page 5-7. Why don't this advance? Okay. So that's a purchase return. A return is the merchandise is shipped back to whomever you bought it from. An allowance is you keep the product, but they give you an allowance of price reduction. Okay. So that would have to be on the next page, which I'll cross my fingers and hope the page turns. Yes. Yeah. Now they're talking purchase discount. I didn't see the allowances. I can't. They're not showing us an example of the allowance. Okay, right under where they show the 2T accounts for the merchandise inventory, underneath the entry of June 6th, they talk about it. The exact same entry is made for a purchase allowance granted to the buyer from the seller because the allowance also reduces the cost of the inventory. The only difference between a purchase return and a purchase allowance is in the case of allowance, the purchaser gets to keep the inventory. So we would reduce the inventory dollar-wise, but not unit-wise for an allowance, and we would reduce the liability accounts payable, because the vendor is giving us an incentive to keep the products that were scratched or damaged or the wrong color, wrong size, what have you. Okay, the discount terms. We saw this on the invoice. They said it was a 3/15 common net 30 days. It's always the first number is the percent of the discount. The number after the slash is the discount period in days, 15 in this case. Okay. Net 30 days. Sometimes it'll be net 30, N/30, meaning net 30. A couple, they show it at the end of that paragraph, 15, 3/15, comma, N30. It's the same thing. 3% within 15 days of the invoice date, net amount due within 30 days. So if you had 210, comma, net 30, it would be 2% discount if you pay within 10 days. They offer these discounts to speed up their cash collections and give you an incentive to pay quickly. All right. Sometimes you'll see it EOM, end of month, as the net amount. Okay, EOM. Come on. Okay. Purchase discount is applied on the amount owed. If a business returns merchandise inventory or receives a purchase allowance before payment is made, the purchase discount will be calculated net of the return or allowance. Okay. Keep that in mind. So you'll see they set back at $2,000 where we've got a reduction. You only discount the balance. The purchase discount is a credit to the merchandise inventory account because it literally reduces the cost that you paid for that inventory. Okay, you can see that in that little entry there, just above page 5.9. I don't know if it's the bottom or top of page 5.9. I can't tell with this electronic textbook. So they're making payments. So accounts payable will be debited for $28,000. The check cash, the check they're sending to Southwest Direct is the $28,000, which was the $35,000 less the $7,000 return is $28,000 net. The 3% of that is the discount of $840. That's the payment, $27,160, and that discount amount $840 is a credit to the asset account merchandise inventory. Okay, it's reducing the price we're paying, the amount we have invested in that inventory. Let's see, what if instead Smart Touch Learning pays his invoice on June 24th after the discount period ends? Well, then they pay the full $28,000. And they show you the entry there on page 510, just above the ethics comment there, heading, accounts payable for the full $28,000. That would be the original invoice of $35,000 less the return of $7,000 worth of laptops or tablets. I forget what they were. Yeah. Ethics, how did you handle gifts from vendors? It's common practice. Within reason is good. With if it gets excessive, you may. A lot of companies have policies against having any acceptance from any vendors. Some of them that have less ethics will actually go out and look and deal only with people that will shower them with gifts and other things. They say the solution, Anthony should contact his purchasing manager and explain the situation. By accepting the football tickets, he may unknowingly be violating the company's code of ethics. Right. How should the company decide if it should pay within the discount period? We'll see. Sometimes it's even advisable to borrow money, depending on interest rates and what the discount is. Companies should, if you have the cash available, take advantage of the discount. You saw it was a little over $1,000 there for Smart Touch Learning. You do that once a month, that's $12,000 a year. Do it once a week, that's $52,000 a year. Second, the company should evaluate the cash should be used for a more profitable purpose as other than getting lower cost of your inventory. Then they talk about the borrowing money to do it. Sometimes it's advantageous depending on the interest rates and the length of the loan. Transportation costs. This is important. The theory here is whenever you're dealing with an asset, and we'll see this more in Chapter 9, it's not only the cost you're paying for the asset, but any cost to get that asset where you need it and used as intended. More so with equipment, property, plant, and equipment, than with inventory, but it's also applicable to inventory. So you have to pay for goods. Free shipping, no such thing. It's in the cost of the goods. They just tell you it's free shipping and make you feel good about it. Now, there's two important terms here. FOB shipping point, FOB destination. FOB is it says free on board. The old people used to say freight on board. Either way, it's FOB, free or freight on board. It's an important thing because it designates who's going to be picking up the shipping costs, but more importantly, it determines when ownership title passes between buyer and seller. Okay. FOB shipping point, the buyer pays the freight. FOB shipping point means the buyer takes ownership of the goods when they leave the seller's place of business. Okay. So once they're on the truck, they belong to the seller. Why is that important? Well, what happens if the truck gets hijacked or in an accident or catches on fire and the inventory in the back burns up? Whose insurance claim Who does the filing of the insurance? Okay. Whose balance sheet does that appear on? Think this is a trillions of dollars of inventory. Just look at the trucks that are crisscrossing the road. Those trucks, half of them might be full and half might be empty. Well, the half that are full, whose inventory is that? Does that belong to the seller or does that belong to the purchaser? So it determines who pays the freight, but more importantly, who owns the goods when ownership changes hands. FOB destination is the opposite. It means the buyer takes ownership when they arrive at the buyer's place of business. Okay. In this case, the seller pays the freight because they still own the goods. And again, if something happens in transit, who owns the inventory? Who has to call their insurance company and file a claim? Now, when merchandise are required to pay for shipping, those costs are classified as either freight in or freight out as follows. Freight in, the transportation cost to ship goods to the purchaser, and thus it's freight on purchased goods. Freight out is transportation costs to ship goods out to the seller's warehouse and to the customers. Okay, thus freight on goods sold is to a customer. Freight in. When the term's FOB shipping point, the buyer owns the goods while they are in transit, so the buyer pays the freight. The freight is a cost that must be paid to acquire the inventory, so it should be included in the cost of the inventory. Okay. So you can see the $60 freight bill there. It's not charged to shipping expense. It goes into the inventory account. It increases the asset and paid with cash. Okay. The freight is not subject to the credit terms if there's a discount. The discount only applies to the merchandise, not the credit, not the transportation cost. Let me show you some entries there of how that would work. Trying to turn the page again. Oh, it worked this time. Net inventory cost equals the purchase cost of the inventory less the purchase returns and allowances, less the purchase discount, plus the freight in. Pretty simple there. Simple arithmetic. So they show you the computation there. Purchases of $697,000, $697,710, less the returns of 150, less the purchases discount, plus the freight in, and there's your total cost of your inventory in that situation. Oh, come on, turn the page. Oh, good. I hit it 3 times. It only went 1 page. Sales on account, no discount. This is now Smart Touch Learning selling it to their customers. Okay, they say we sold 5 tablets to Pendleton Dentistry for $500 each. You got to be careful now because the cost of the inventory is what we're paying to obtain it, and then the sale price is at retail. So you have 2 prices there. The price we pay, the cost, $500. We're paying $350. Okay, so there were 5 of them. So 5 times 500, that's $2,500. And we're making $250 each. So the cost of the computers were $350 times 5 was $1,750. So you got to be careful because we got 2 different numbers dealing with these. When it's a sales invoice, it's at selling price retail. The $350 we're getting it from Southwest Direct is the wholesale cost. So here we're selling it to our customer, the dental Pendleton Dentistry, and 5, credit terms in that 30 days. So we're not giving them a discount. We don't know them, and we want $2,500. Okay. Now, the main part of the chapter, it's assumed, and it's always assumed it's a perpetual inventory system unless you're told otherwise. So whenever you have a sale with a perpetual inventory, you have to do two entries. One to record the sale, and a second one to record the fact that inventory was reduced. So you can see on page 5-14 there, they have the entry. The first entry is to record the sale, accounts receivable from Pendleton Dentistry, $2,500. That's the retail price, 5 computers at $500 a piece, and sales revenue, or sales, $2,500, a revenue account. Right underneath that is the corresponding entry to record the requirement of the perpetual inventory to reflect the fact that our inventory is now down 5 units that we paid $350 a unit for. So we have to reduce the merchandise inventory, the assets. We no longer have those 5 computers. They're on their way to Texas to the dentist's office. So we reduce the inventory asset by $1,750, and $1,750 goes to the cost of goods sold. Again, think about the adjusting entries. You probably don't want to, but an asset has been used up. We no longer have the asset. We have sold the asset, and we have gained revenue by selling the asset. The difference between the $500 sale price and the $350 cost is our gross profit, $150 per unit. Okay. I'm going to try and turn the page again. And it'll work. Just as we had purchase returns and allowances, we can have sales returns and allowances. Okay. The return of goods is called a sales return. So just reverse the entry of the sale. We're getting the merchandise back. We have to increase the inventory. We have to reduce the receivable from the customer. Okay. Now, sales returns reduce the future cash collected from the customers will require a refund to be made. Under the new revenue recognition standards, during the adjusting process, companies estimate the amount of sales returns from the customers that will occur. Okay, so you have to set up an estimated returns inventory account and a liability for refunds payable. Okay, haven't paid them yet. This is before the fact, based on estimate. When a customer returns the merchandise inventory, the customer will need to record a refund of cash to the customer and a credit to accounts receivable. The company must also record the return of merchandise inventory. Assume that on June 22nd, customer returned the merchandise purchased with cash with the sales price of $2,000. The cost of goods sold was $800. So Smart Touch Learning would need to record 2 journal entries to record this return, this transaction. The first entry records the cash refund, and the second records the return of merchandise to inventory. Okay, and again, you're dealing with 2 different values here. One is the retail selling price, and the other is the cost of the inventory. Okay, so the refund payable liability is going to be reduced, and the cash is going to be refunded to the customer. So refunds payable gets reduced, and the asset cash gets reduced for the refund. Then the inventory, the merchandise goes back to the inventory account, the asset gets debited, and the estimated return inventory gets the credit. Okay. And they show you what the balances would look like after you post this. And a sales allowance is the seller grants the customer a reduced price as an inducement to keep the product because it was scratched or damaged or wrong color or whatever reason they weren't happy with it. They don't want to do a return. So they'll say, hey, knock a couple bucks off. So here they have a $100 sales allowance, and there's the entry, the refunds payable, and the accounts receivable gets the credit, refunds payable gets the debit. Okay. Again, these things are done ahead of time. to do a better job of matching. Hey, turn the page on the first tab. Sales on account with the discount. Okay. Now, when we're buying the stuff, we record it at its full price and then reduce it for a discount once we take the discount. You don't reduce the merchandise inventory for the discount until you earn the discount. It's the opposite with the sale. With the sale, you're going to, for the sake of conservatism, so you don't overstate sales, you're going to record it at the discounted amount. And if the customer does not take advantage of the discount, we will then use a discount forfeited account. So we don't prematurely recognize revenue. Okay. I just moved too much on me. Oh, come on. And then this thing pops up in the column when I'm trying to scroll up. Okay. Okay, sales discounts. We sold 15 tablets at $500 each, so that would be a $7,500 sale to the West High School. Goods cost $5,250. So again, perpetual system. We have to record the sale. But look, the sale was for $7,500, and we're offering them a 2% discount if they pay within 10 days. So we're going to book the sale at a 2% discount, or 98%, 100% minus a 2% discount times the $7,500, and we'll record this accounts receivable and the sales revenue at the net amount of the discount, $7,350. Debit to receivables, credit to sales revenue. The cost of goods sold is based on the cost of the inventory. Usually they'll tell us what it is here. $5,250. So the cost of goods sold gets increased by $5,250. Merchandise inventory gets reduced with a credit of $5,250. Okay. When they make the payment within the discount period, Smart Touch Learning will record a receipt of cash for $7,350 and the accounts receivable as $7,350. Okay. Now underneath that, they'll show you what happens if they don't pay within the discount period. If the high school does not pay within the discount period, the customer will no longer receive the $150 discount, the 2% of the $7,500 total purchase, and they must pay the full $7,500. So we're going to debit cash for $7,500. Remember, we recorded receivables at the net discounted amount, so we have to reduce it by we have to credit it for $7,350, and then the balance goes into a sales discount forfeited account. Debits and credits must equal. Okay. But again, we recorded it at the sale at the net amount as if they're going to take the 2%. If they fail to take the 2%, we still have to get that receivable canceled at the same amount we booked it at, debited it at. And the difference goes into the sales discount forfeited account, which is an offset of sales revenue. We'll see how that works later on with the exercises and problems. Transportation costs to customers, it's usually a delivery expense and we cash. So they show us that on page 518. Okay. Turn the page again. Hey, I'm getting good at this, I guess. What are the adjusting and closing entries for a merchandiser? Well, regardless of what system you use, perpetual or periodic, you must take a physical count and agree it to your records. We know that inventory has a habit of shrinking, whether it's due to employee theft, customer theft, or just, maybe it gets flooded, maybe it gets damaged and your customer's looking at it and they drop it and it's no good. You can't sell it. So you junk it. So you have to reconcile what you actually have on hand by doing a physical inventory and then adjust the records down. So any increase will go to the cost of goods sold. Okay. Cost of goods sold, they show you there, $1,530 difference between what the account tells you, $31,530, and the account on hand based on the inventory is $30,000 of inventory. So the difference is $1,530. You reduce the inventory with a credit, and a debit goes to the cost of goods sold. It's a selling expense. Inventory, you're working in a bakery and a guy's coming out with a couple of cakes and somebody bumps into them and the cakes fall on the floor. Well, you can't sell them. That's inventory is non-sellable. It has to be written off. It has to be reduced. Okay, and now just when I thought I got good at turning pages, I can't turn the page in. I'm using a touchpad. Maybe if I had a mouse, it would be better. Okay, that was it. Now, what about the closing? Okay, the first adjusting entry is the sales debit to sales revenue, reduce the sales for the year by the expected amount of returns and refunds payables, liability account. So that doesn't get closed out, but the refund expense would. Second adjusting entry, debits an asset account, estimated returns inventory, represents the cost of the inventory the company believes it will receive in returns, corresponding credit to cost of goods sold. Decreases the expense, estimated returns inventory. Closing the accounts of the merchandiser. Same thing, same four-step process, but now we have to close, we have to take into consideration these new accounts. They highlight them there in the adjusted trial balance, merchandise inventory, estimated returns, inventory, refunds payable, sales revenue, sales discount forfeited, cost of goods sold, delivery expense. A couple new expense accounts, a couple new revenue offset accounts. There they show you the adjusting entries in page 521. I'm looking if there's an exhibit number on here. Yeah, exhibit 5-6. Show you the adjusted trial balance and then the closing entries. Okay, cost of goods sold is an expense account, so it has to be closed out. Sales revenue and sales discount forfeited are revenue accounts. They have to be closed out. The delivery expense, that's another new expense account. That has to get closed out. And the income summary gets closed out to retained earnings, and dividends gets closed down, just like before. You see there are four entries there. One to close revenues. Well, now you have a couple revenue accounts. Second one to close the expense accounts. You got a couple new expense accounts have to be closed. The last step 3 and 4 are identical to what we were doing in chapter 4. Now you give the 4-step process. Same process. The only thing is now we have a couple revenue accounts, multiple revenue accounts, and a couple new expense accounts. Financial statements prepared, same way they always were prepared, okay? Now, they show you in figure 5-7, a single for Smart Touch Learning when they're selling products. They have sales revenue. I guess I forgot about their service revenue. Sales discount forfeited. You combine those two. Those are your total revenues. And then you have all your expenses. Now compare that and notice that the net income of $101,420 is going to be the same as it is on the multiple step income statement, which is shown on page 5-25 in exhibit 5-8. I scroll down too far. You can see that it's longer, lengthier, it's more detailed. It has more sections to it. The gross profit up the top. Net sales revenue less the cost of goods sold, net profit. Then they list operating expenses and they break them down between selling expenses and administrative expenses. Selling expenses are the ones that are directly related to selling. The salaries of the salespeople. Okay. So you have salaries expense under the administrative. Those would be the people that work in the office. Okay. Not directly related to selling. Rent expense, 38,280. That would be related to the floor space in the store. Then you have rent expense under administrative expenses. That would be the office rent, the square footage taken in the office. If they're in the same building. If they're in different buildings, then it's easy to split out. If they're in the same building, you do it on the basis of square footage. Advertising expense and depreciation on the building delivery expense. Advertising directly related to sales. You don't see advertising expense under administrative expenses because it's not related to, it's only related to selling. Okay, so then you have total operating expenses. You subtract that from the gross profit up above in that column, and you get operating income, a very important number. People say, what's the bottom line? What's the bottom line? Well, the bottom line here is net income of 101,420. But I say that operating income may be more important because that tells you how the company is doing from their principal endeavors, what they do 24/7, 365 days a year, operating. The other thing, other income, other income expenses are ancillary. Those are things that may not occur on a routine, regular basis. Those are things that are not an integral part of the company's operations. They're ancillary. Sales discounts forfeited, minor item. Interest expense, minor item. And there could be some other things listed in that section that aren't listed on this particular one. So you have total other income and expenses, $9,000 loss. Income before income taxes, an important number. Income tax expense, and then finally net income. So you can see the multi-step income statement, and it's only used for merchandisers. Law firms aren't selling products. Accountants aren't selling products. We're selling services. So we wouldn't use because we won't have cost of goods sold. We'd only have associated expenses of running the business. So they break it down there. They talk a little bit about the selling expenses, our operating expenses related to marketing and selling goods and services. Administrative expenses are not related to marketing, goods or services. HR, finance people, okay, the accountants, those type of people. Office workers, executives. Now you can have sales executives, VP of sales. They 100% devoted to marketing and selling. They would be listed there. Okay. Same when we change earnings balance sheet, same thing, except now we're going to have a new current asset with merchandise inventory on the current asset portion of the balance sheet. Okay, gross profit percentage, as they are wont to do, our authors always introduce a finance, except for that one chapter we already covered, gross profit percentage. Gross profit divided by net sales revenue. Okay, it measures the profitability of each sales dollar above the cost of goods sold. So it tells you how much of each dollar goes to purchase the inventory sold and how much is left to cover other operating expenses. Okay. They show you that for Kohl's Corporation, the computations, give you a little practice with it, a little bit of understanding. And that should be it for chapter 5. It's beyond the scope of these course, multiple performance obligations. Yeah. So, usually when you hit that financial ratio, it designates the end of the chapter. And then they go through the periodic system, which, again, not too many people use anymore. Okay, so that'll about do it for just about an hour. Okay.